We are all sort of wired for the high of the discount, aren't we? I mean, everyone dreams of buying at the absolute bottom, that ultimate buy the dip moment.
Oh, absolutely. That feeling of catching a massive deal, maybe a once-in-a-lifetime one, it's intoxicating. It's probably what gets a lot of people interested in investing in the first place.
Yeah, it speaks to this deep human desire for control, maybe.
hmm
The idea that we can outsmart the crowd.
But here's the challenge, the thing the data throws back at us. What if we told you that even if you were like this all-knowing entity who always hit the bottom perfectly every single time, you'd still likely underperform the simplest, most, well, boring strategy?
And that is the core conflict we're diving into today. It's the classic investment battle, really. Discipline versus guesswork. Buy the dip, BTD versus dollar cost averaging, DCA.
Exactly. Do you spend your energy chasing those high but super unpredictable returns trying to time the market? Or do you rely on the slow, steady power of just being in the market over time? That's our mission for this deep dive.
Welcome to everything you need to know about finance. Just a quick heads up before we dig into the numbers, folks. What we're exploring here, it's purely for educational purposes, okay?
Mhm.
This isn't financial advice. It's just us taking a really close look at the historical data, seeing what these strategies have actually done.
Right.
And hey, if you find this kind of stuff interesting, maybe even valuable, please do. Consider engaging with us. Like, subscribe, you know the drill. It helps us bring you more deep dives like this one.
Yeah, definitely. So our goal today is really to unpack the research, look at the numbers, and show the immense mathematical and, frankly, psychological risks you take on when you try to outsmart the market.
Okay, let's start with the basics then. But maybe focus on the mechanism of each strategy, because that's where things really start to divert, isn't it? We're not just comparing
Yeah.
acronyms here.
Good point. We're comparing philosophies, really.
Yeah.
So dollar cost averaging, DCA, it's pure discipline. It just means investing a fixed amount of money, say $100, could be anything, at regular intervals, like clockwork. First of the month, maybe.
Regardless of the price.
Exactly. Regardless of whether the price is up, down, sideways, the mechanism is super simple. It smooths out the bumps, the volatility. It usually lowers your average purchase price over time. And crucially, it takes your emotions completely out of the decision.
Okay, discipline, steady. And then BTD, buy the dip, or market timing. That feels like pure aggression, maybe opportunism.
That's a good way to put it, yeah. With BTD, you hold onto your cash.
Yeah.
You wait. You're watching for a significant drop, a dip in whatever you're looking at, a stock, an index, whatever, before you jump in.
Right, you're specifically trying to grab that temporary discount.
You're hoping it's the bottom, right, before the price rockets back up.
So the initial comparison already shows this massive difference in risk. DCA seems almost effortless, no timing needed, risks spread out,
Yeah.
built for the long haul.
Pretty much.
Yeah.
Ideal for long-term sort of passive wealth building.
Yeah.
Whereas BTD, well, it demands accuracy. You have to be right.
High risk, concentrated risk.
Yeah. And it's much closer to trading than long-term investing.
Right.
Honestly, probably best suited for pros who can genuinely afford to lose money while they wait for that perfect moment that might never come.
Okay, but you led with this incredibly bold claim that even the perfect market timer usually loses. I gotta represent the listener here. That just sounds wrong. Impossible, almost.
Right. It feels counterintuitive.
How did researchers even test that? How do you set up a scenario where one side has, like, godlike foresight?
Yeah, it's a fascinating thought experiment. Researchers took a long stretch of historical data, specifically tracking 40 years of market behavior, from 1920 all the way to 1979. That period saw everything, right?
Right.
Huge crashes, strong bull runs.
Okay.
And they compared two imaginary investors, both investing the same amount, let's say the equivalent of $100 every month.
Yeah.
Now, the DCA investor did exactly what we described. $100 in every single month, no matter the market weather. Simple.
Okay.
The BTD investor, though, this one, was gifted with impossible perfection. They saved that $100 each month. They only invested it when the stock price dropped below its previous all-time high.
Oh,
And here's the kicker. They magically bought at the exact lowest point of every single dip.
wow. Perfect timing. Never missed the absolute bottom.
Never missed. Impossible in reality, of course.
But what happened? The perfect timer must have crushed it, right?
You'd think so. But the astonishing result was the perfect buy the dip strategy actually underperformed the simple, boring DCA strategy over 70% of the time
Hmm.
across that entire 40-year window.
Get out. 70%. even with perfect timing.
70%.
That is genuinely shocking. I mean, I absolutely could bet on the perfect timer every single time. That turns investing logic on its head.
It really does. And this isn't just some weird result from that one specific time frame. We looked at broader research too, like analysis of 30 years of actual S&P 500 data. More recent stuff.
Okay, what did that show?
So the straightforward DCA approach, it produced a 254% return over that period. Actual market timing strategies where real people or complex algorithms tried their best to predict the dips they returned, somewhere between 227% and 252%.
So they underperformed DCA too.
Most did, yeah.
Yeah.
And even if you had access to some theoretical perfect foresight model in that data set,
Yeah.
the return only nudged up to 289%.
So let me get this straight. Even in the absolute best case, theoretically perfect scenario where BTD did slightly win, the timing had to be utterly flawless, which nobody can do, and the extra reward was surprisingly small compared to just being consistent.
Exactly. Which really makes you ask, what on earth is going on here? What force is powerful enough to beat perfection? How can boring consistency possibly win against impossible knowledge?
It must come down to time itself, right? The time you spend waiting.
That's a huge part of it. It basically boils down to two incredibly powerful, mathematically solid forces that the BTD investor just fundamentally ignores. The first one is exactly what you said, the sheer cost of waiting. We call it miscompounding.
Ah, okay. That's the core problem, isn't it? While Mr. or Miss Perfect Timer is sitting there, patiently waiting for the ideal dip, their cash is just sitting there, maybe in a savings account earning next to nothing.
Or worse.
Yeah.
Yeah, basically doing nothing, not growing at the market rate. Meanwhile, the DCA money is always in the market. It's always working, always potentially earning a return. And crucially, that return then gets reinvested to earn more returns. That's compounding.
Right.
Think about it simply. If the market historically averages something like, say, 8% a year, and you hold $10,000 on the sidelines for just 1 year waiting for that perfect dip, you've basically chosen to forfeit $800 in potential growth.
And that $800 itself would have started compounding the next year and the year after.
Precisely. The effect is exponential. It snowballs. You're not just missing 1 year of growth on the initial 10 grand. You're missing decades of potential growth on the growth itself.
Wow.
And that loss happens every single month you decide to wait instead of invest. Look, most of market history is actually characterized by upward trends, by growth. By waiting for a dip, you are making an implicit bet.
You're betting the dip will be so huge.
So huge and timed so perfectly that it makes up for all the steady, boring compounding you missed during the potentially years-long bull run leading up to that dip, and mathematically,
Right.
over the long term. That bet just rarely pays off.
Okay, that makes sense. And that leads straight into the second factor, right? Which is just how rare are those really big, juicy dips you're waiting for?
Exactly. If you're holding out for a dip big enough to justify missing, say, 5 years of solid market growth and compounding,
Yeah.
well, you might be waiting a very long time.
Decades, maybe?
Could be. Market downturns, the kind of environment where BTD looks like it could be a winner. Think 2008, think the dot-com bust, think way back to the Great Depression. Those are relatively rare events over a typical 40-year investing lifetime.
Whereas DCA doesn't wait for a sale.
Nope. It just keeps buying, capitalizing on the steady upward grind during those much more common bull markets. You're constantly capturing small gains, capturing dividends, reinvesting, while the timer is just watching, waiting, and missing out on all that.
Oh, wait, hang on. If I know historically that a major correction tends to happen every, 7 to 10 years or something, why can't I just save up my cash and wait for the inevitable crash? Are you saying my money should just sit there losing value during a recession if I'm using DCA?
That's where you hit the real-world impossibility of timing it. First off, nobody rings a bell at the market top, right? Yeah. And nobody blows a whistle at the absolute bottom.
True.
The dip you decide to buy might feel like the dip, but it could just be the first step down in a much bigger crash you could buy way too early. But let's talk about the precision needed, even if you could magically know a bottom was forming.
Okay.
There was one analysis we looked at. It cited this terrifyingly thin margin for error. If you try to time the market in the real world, not the perfect fantasy land, just missing the bottom by 2 months.
2 months? That doesn't sound like much.
Doesn't sound like much, but missing it by just 2 months, buying 2 months too early, or maybe 2 months too late, it absolutely crushes your chances of beating simple DCA. Your probability of outperforming drops from maybe 30%, which was already only possible with perfection, down to a measly 3%.
3% chance of beating DCA if you're just 2 months off.
3%. So you have to ask yourself, especially if you're a regular investor saving for retirement or some other long-term goal, Why on earth would you accept a 97% probability of underperforming just because you tried to chase that impossible timing?
The cost of being even slightly wrong is just enormous, which explains why the data keeps pointing back to the person who has simply always invested.
Right. Let's make it concrete. Look at a specific period. The U.S. stock market, say January 1995 through December 2018, covers some big ups and downs.
Okay, dot-com bubble, 2008 crisis.
Exactly. The DCA investor, their portfolio shows this incredibly, almost boringly steady upward climb. They invested right through the dot-com crash, kept putting money in. They kept investing straight through the 2008 financial meltdown. Their average cost just kept adjusting.
Meanwhile, the BTD strategist was presumably sitting on piles of cash in 96, 97, 98, watching the market soar.
Watching it soar, exactly. That BPD strategy, to even begin to catch up, had to rely almost entirely on nailing that massive generational market bottom in March 2009, right after the great financial crisis.
A moment of pure panic for most people.
Utter panic. So DCA was leveraging time, the power of consistency. BTD was relying solely on catching lightning in a bottle. Perfect luck during a global catastrophe.
We should probably acknowledge, though, that BTD has worked in some really specific, severe situations historically. You mentioned the Great Depression earlier.
Yes, absolutely. You can point to periods like, say, 1928 to 1957. The incredibly severe crash of 1932 created opportunities for massive rock-bottom buys if you had cash in the nerve. But that extreme situation just highlights the massive caveat, doesn't it?
Yeah.
BTD can look amazing retrospectively if you happen to invest right after an unpredictable, world-altering collapse that offers once-in-a-century discounts.
But those opportunities are exceptionally rare.
Exceptionally rare, incredibly hard to predict, and even harder to act on psychologically when everything feels like it's ending. And if you miss that very narrow window at the absolute bottom, you're likely far worse off than the DCA person.
And crucially, this principle seems to hold up even with newer, more volatile stuff, right? Which is important because lots of listeners are interested in things beyond just the S&P 500.
It really does. We saw research, including analysis from Galaxy Asset Management, that looked at data from 2007 right up to 2024. So pretty current.
Okay.
And they found DCA came out ahead not just for standard S&P 500 funds, but also for notoriously volatile assets like, yes, cryptocurrencies.
Interesting. So even with crypto's massive swings.
Even there, the fundamental power of discipline, of consistency, of removing emotion and benefiting from time in the market, it seems to endure across different asset classes, from stodgy old blue chips to the Wild West of digital currencies.
Okay, so given that the data is pretty overwhelming, but that human urge to buy the dip is so strong, how do real investors deal with this? How do you reconcile that psychological pull with the statistical reality?
Yeah, that's the million-dollar question, isn't it? And it leads to what you might call a practical middle ground, or maybe a hybrid approach, an augmented DCA, perhaps?
Okay, what does that look like?
Many savvy investors realize, okay, DCA should be the bedrock. That's the foundation. Maybe that's 80%, maybe 90% of their regular investment strategy. Consistent, automated, boring.
Right.
But then they might set aside a small percentage, say 10%, maybe even less, specifically to satisfy that urge. A little bit of play money to try and time a dip, or maybe just to buy slightly more than their usual DCA amount during periods when the market feels low.
Ah, so you still get the core benefit of DCO.
Exactly. You get the discipline, the compounding, working on the vast majority of your capital. But you also give yourself that psychological release valve, that feeling of maybe capitalizing on a sale without jeopardizing your main long-term goals. It's kind of a compromise with our own human nature.
That makes a lot of sense. So wrapping things up, the synthesis seems pretty clear then. For most people, especially those investing for long-term goals like retirement, DCA offers this reliable, less stressful path.
Absolutely. And a huge part of its advantage is psychological. It's a strategy designed to help you overcome those twin demons of investing. Fear and greed.
How so?
Well, think about a market drop. Say the market falls 20%.
Hmm.
The BTD investor, or someone trying to time it, often panics. Did I buy too early? Is it going lower? Should I sell? The DCA investor, though, they learn to reframe it.
Reframe the drop.
Yeah. That 20% drop isn't necessarily a loss on their whole portfolio view. It's just a temporary situation where at their next scheduled investment date, they get to buy more shares on sale automatically. It locks in lower prices without them having to make a stressful decision.
So the key differentiator really isn't about knowing when to invest.
It's about being invested consistently.
The goal isn't hitting home runs by timing the market perfectly, but just steadily getting on base, month after month, year after year. building that wealth through the relentless power of compounding over decades.
Precisely. And what's really fascinating looking ahead is that while this core principle of DCA consistency beats, timing holds incredibly strong, the research doesn't stop there. People are actively looking into ways to potentially modify or enhance DCA. Well, things like dynamic DCA or value averaging. Strategies that might use specific economic indicators or valuation metrics to slightly adjust the amount you invest each period. Maybe invest a bit more when things look cheap, a bit less when they look expensive, but crucially, never stopping the regular investment entirely.
Interesting. So it's not about throwing DCA out, but maybe fine-tuning the consistency.
Exactly. It suggests that while perfect market timing is likely always going to be a fool's errand, the disciplined, consistent investor might still have room to learn, adapt, and optimize their approach. The future of smart investing might not be about trying to time the market, but about perfecting the art of consistency.
That's a great thought to end on. So maybe the final question for you, the listener, is this. Consider your own gut reaction to market swings. Does the thought of waiting for that perfect dip paralyze you? Does it leave your cash sitting idle, earning nothing while the market potentially climbs without you? Or can you trust the process, trust the market's general upward trend over the long haul? Your honest answer might just tell you exactly which strategy, discipline, consistency, or speculative timing is truly the best fit for your own long-term financial success.